Hello everyone, thanks for checking out my video. I am a little hesitant in doing up this video because the first video on options trading didn't generate much views, and so I am not sure how many people can benefit from such videos, considering the amount of effort required to put in to churn out this content. Anyway, here I am producing the second video for beginners who would really like to learn more about options trading. So in this video, I will cover 4 basic option strategies, namely long put, long call, short put, and short call. I will try to go a little slower so that it's easier for viewers to absorb, hopefully. And without further ado, let's go. First up, let's cover the long put strategy, which involves buying a put option on a stock or other underlying asset. But for the purpose of this video, let's just all use stock as an example since I don't trade options for other assets anyway. Alright, so when do you use this strategy? You use it when you think or speculate that the price of the stock is going to decline. In short, if you buy the put option, you are bearish and you want the stock price to go down. I have shared this in the part 1 video, do check it out if you haven't. Link is at the top. Anyway, how this strategy works is that you will have to pay a premium or price to buy a put option with a specific strike price and expiration date. This then gives you the right, but not the obligation, to sell the stock at the strike price before or at the expiration date. The maximum potential loss for this strategy is limited to the premium that you paid for the put option. It is important to understand the maximum loss potential so that when things go south, you know what to expect in terms of how much you can lose. Again, I must emphasize this is very important as there are investors who are not aware of their maximum loss potential when trading options and saw their portfolios got wiped out. In terms of profit potential, as the stock price falls, the options value can increase significantly, providing substantial profit potential. In essence, you can profit through 2 methods. The first method is you can sell the put option contract that you bought earlier at a higher price. This is what we call closing the position. Here's a simple explanation. When you buy an option contract, you will have one open position. And to close this open position, you will have to sell the option away. But of course, you would want to sell it at a price higher than the premium that you paid. More on this later. The second method to profit is to exercise your option right by selling the stock at your strike price if the stock falls below the strike price. Okay, are you feeling a little confused? Let's use an example to explain. Suppose you are an investor who is bearish on the stock of company ABC. The stock is currently trading at $50 per share, but you believe that the stock price will decline in the coming weeks due to some negative news about the company's financial performance or for the other reasons. To profit from your bearish outlook, you then decide to implement the long put strategy. You then proceeded to buy a put option with a strike price of $45, expiring in 1 month. The premium or price for this put option is $3. Don't forget, as mentioned in part 1 video, each option contract represents 100 shares of the underlying stock. So you are actually paying $3 times 100, which is $300 for this put option, excluding any transaction costs. After which, there are 3 potential outcomes for this trade. First up, scenario 1. If the stock price of company ABC increases or remains above your strike price of $45 by the expiration date, your put option will expire worthless. You will then lose the entire premium that you have paid. In other words, $300, which is the maximum potential loss in this strategy. Therefore, the loss for this strategy is capped and the risk is limited. Scenario 2. If the stock price of company ABC declines below $45 by the expiration date, your put option becomes more valuable. Basically, for every dollar the stock price falls below $45, your put option will gain $1 in intrinsic value. Too difficult to understand? A simple explanation would be, as the price falls below the strike price of $45, the premium of this option will increase. From here, you can get some profit by closing your position before expiration. Here's how it works. Remember, you paid a premium of $3 per share for this put option and you have an open position. So let's say the stock keeps falling and as a result, your option value becomes more valuable. For instance, it became $4. Then you can close this position before expiration by selling away the position that you have on hand. By doing so, your profit will be $1 per share, in other words $100. Alternatively, as shared earlier, the second method to profit is to exercise your option right by selling the stock at your strike price. For instance, the stock price drops to $40 by expiration. You can then choose to exercise your right to sell the stock at your strike price of $45. This means you make a profit of $5 times 100 shares, in other words $500. But of course, you will still have to deduct the $300 premium that you have earlier paid from this $500 profit. And as a result, your net profit for this trade is $200. Okay, right now you may wonder why is the profit of closing the position lower than exercising the option, and why would anyone want to close their position then? Well, the simple explanation on whether a person wants to exercise the option or close the position depends on various factors, including market conditions, time remaining until expiration, transaction fees, investors' outlook of the stock and its price, market volatility, etc. etc. There are actually situations where it is the other way around, where closing the position gives you more profit than exercising your right. More on that later in the long call segment. Furthermore, the buyer of the put option may not want to sell away his or her existing 100 shares, and so the buyer may not want to exercise his or her right. The third scenario is the break-even scenario. You actually wouldn't want to let this happen. You will probably want to close your position before that. I mean, if it really goes to a break-even point on your expiration date, you basically had wasted your time doing this trade. In fact, you would have incurred some transaction costs. Anyway, to break even, the stock price must be equal to the strike price minus the premium paid. In this case, the break-even point is $45 strike price minus $3 premium that you paid, and that gives you $42 per share. So if the stock closes at $42, this means there is no net profit or loss. In other words, a total waste of time. Moving on, the next strategy is long call strategy, which involves buying a call option on a stock. This strategy is often used when one is speculating that the price of the stock is going to rise. In short, if you buy a call option, you are bullish and you want the stock price to go up. In other words, this is also the opposite of the earlier long put strategy. But similar to the long put strategy, you will have to pay a premium to buy a call option with a specific strike price and expiration date. This then gives you the right, but not the obligation, to buy the stock at the strike price before or at the expiration date. Also, just like the long put strategy, the maximum potential loss in this strategy is limited to the premium paid for the option. In terms of profit potential, as the stock price rises, the option's value can increase significantly. Once again, this concept is pretty similar to long put. As such, you can also profit through two methods. The first method is when the stock price rises, the value of the contract also increases, and with this, you can sell away the call option contract at a higher price than what you have initially paid. As shared earlier, this action is to close the position. The second method to profit is to exercise your option right by buying the stock at your strike price when the stock rises above the strike price. In short, you are buying the shares at a price that is lower than the current market price. With these shares on hand, you can then sell them at the market price to earn the difference. Okay, if you are getting confused, don't worry. Again, let's try to understand the concept with an example. Suppose you are bullish on the stock of company XYZ, which is currently trading at $50 per share. You believe that the stock price will rise in the near term due to positive earnings expectation or for other reasons. To profit from your bullish outlook, you decide to implement the long call strategy. You then proceeded to buy a call option with a strike price of $55 expiring in 1 month. The premium or price for this call option is $3. Again, don't forget each option contract represents 100 shares of the underlying stock, so you are actually paying $300 for this call option, excluding any transaction fees of course. Just like the long put strategy, there are 3 potential outcomes for this trade. Scenario 1. If the stock price of companies XYZ decreases or stays below your strike price of $55 by the expiration date, your call option will expire worthless, which means you will lose the entire $300 premium that you have paid. and this is the maximum potential loss in this strategy. Similar to long put strategy, the loss for this strategy is capped and therefore the risk is limited. Scenario 2. If the stock price or company XYZ rises above $55 by the expiration date, your call option becomes more valuable. Basically, for every dollar the stock price rises above $55, your call option will gain $1 in intrinsic value. Once again, a simple explanation would be, as the price rises above the strike price of $55, the premium of this option will increase. From here, you can get some profit by closing your position before expiration. Again, remember you paid a premium of $3 per share for this call option. As the stock rises to the moon, your option value will become more valuable, and let's say the premium of this option contract is now worth $8. Then, by selling this call option contract away, you will earn $5 per share, which will be a total of $500 in profit for 100 shares. Alternatively, the second method to profit is to exercise your option right by buying the stock at your strike price. For instance, the stock price rises to $60 by expiration. You can choose to exercise your right to buy the stock price at your strike price of $55. From here, you can sell it at a market price of $60, as a result making $5 profit per share. With 100 shares, your total profit would be $500. But hang on, don't forget you paid $300 premium earlier on. So minus off this $300 from the profit of $500, your net profit is $200. And as you can see in this example, the profit of closing the position is higher than exercising your right, unlike the previous example where closing the position gives you lesser profit. Scenario 3 is the break-even scenario, which I will not explain too much. To break even, the stock price must be equal to the strike price plus the premium paid. In this case, the break-even point is $55 plus $3 premium, which equals to $58. So if the stock closes at $58, this means there is no net profit or loss, in other words, a total waste of time. Alright, we have covered the first two basic option strategy. It's commercial time, so you can take this time to take a break. Anyway, if you like my content so far, please help me with the YouTube algorithm by liking, subscribing and commenting below. This will help to grow the channel. Other form of support includes buying me a bubble tea or coffee at $4 or use any of my referral links below to sign up for Momo, Tiger, Weibo, Shopback, YouTrip and whatnot. Lastly, if you are keen to get hold of the spreadsheet that I use to track my option trades, you can download it for free on my Ko-fi page. And if you would like to check out my real option trades, you can consider buying them from my Ko-fi page as well. Alright, back to business. The third basic option strategy is the short put strategy, which involves selling a put option on a stock. This is a bullish to neutral option strategy where an investor sells or writes put options with the expectation that the stock price will either rise or remain stable, in other words, go sideways. By deploying this strategy, the option seller collects a premium upfront and they become obligated to buy the underlying stock at the strike price if the buyer of the put option decides to exercise their right to sell the stock. This is actually a key difference from the buy put, aka long put strategy, where earlier on, the put option buyer has the right to sell the stock but not the obligation. However, right now as an option seller, you have the obligation to buy the stock. To put it simply, if a put buyer exercises his or her option contract and you as the option seller get assigned with the option contract, then you will be forced to buy the shares at the strike price. Don't worry if you are still confused, it's okay, we will run through an example later. Meanwhile, the maximum loss for the short put strategy occurs if the stock price crashes to zero. In other words, you are being forced to buy the stock at a certain strike price, then the stock price falls to zero, so all the shares you have on hand will worth nothing. And therefore, the maximum loss would be the amount of money you fork out to pay for those shares, minus off the premium that you receive at the start. The maximum profit for the short put strategy is limited to the premium received when selling the put option. So say for example you receive $3 per share, in other words $300 when you sold the put option. That's it. Your maximum profit is $300. It can be lesser, but it won't be more. The investor basically achieves this maximum profit if the stock price remains above the strike price and the put option expires worthless, in other words out of the money. Do you still remember what is out of the money? Otherwise, do check out the first part of my video to understand more. Okay, it's illustration time. Suppose you are slightly bullish on the stock of company ABC, which is currently trading at $50 per share. You believe that the stock price will either rise or remain stable over the next month due to positive earnings expectations or for whatever reasons. You then proceed to sell or write a put option contract with a strike price of $45 expiring in 1 month. The premium received for selling the put option is $2 per share. Multiply it by 100 shares, this means the premium you receive is $200. Again, this excludes any transaction fees. Alright, let's now explore the different outcomes at expiration based on the various stock price scenarios. Scenario 1. The stock price of company ABC remains above the strike price of $45 at expiration. In other words, out of the money. When this happens, the put option you sold expires worthless. You will then get to keep the full premium that you earlier received as your profit. In this case, your profit is $200 minus off any transaction fees of course. Scenario 2. The stock price of company ABC falls below the strike price of $45 at expiration. The put option that you sold has intrinsic value now on top of extrinsic, aka time value. The intrinsic value is equal to the difference between the strike price and the stock price. Confused? Okay, let's say the stock price is $40 now and your strike price is $45. Then the put option has an intrinsic value of $5 per share. Then let's say you did not manage to close the position at the expiration date, you will be obligated, in other words forced to buy 100 shares at $45 strike price. So you will need $4,500 to acquire these 100 shares. From here, if the stock price crashes to zero, then obviously you will lose the entire $4,500. But remember, you received $200 premium at the very start, which means your total loss would be $4,300. Sounds scary? Here's a good news. To avoid this kind of maximum loss in short put strategy, you can choose to close the position before expiration. Closing the position in this case means buying back the put option that you initially sold to open the position. By doing so, you eliminate your obligation to buy the underlying stock at the strike price. The loss upon closing the short put position will depend on the difference between the premium initially received and the premium paid to buy back the put option. Confused? Okay, for instance, remember you sold this put option and received $2 premium per share at the very start? Right now, because the stock keeps falling, this contract will become more expensive and say it's worth $8 per share now. This means you will need to buy back the contract at $8 per share to close the position. So the calculation would be $200 premium received minus $800 premium paid, and therefore your loss is $600. Better than the earlier $4,000+, right? So yep, the gist of closing the position is that your potential loss is limited. Okay, here's a quick tip to limit your maximum loss, and that is to select indices of solid companies like Apple, Microsoft, etc., where the chances of them crashing to zero in the near term is very low or almost not possible. Alright, moving on, of course there is a scenario 3, which is the break-even scenario, and as shared earlier, it's a waste of time scenario, so let's not waste time covering it again. Okay, if you have stayed till here, good job to you. I shall give you a thumbs up, and I hope you can give me one too. Anyway, the last basic option strategy is the short call strategy, which involves selling a call option on a stock. This is a bearish to neutral option strategy where an investor sells or writes call options with the expectation that the stock price will either stay the same or decrease. By deploying this strategy, the option seller collects a premium upfront, and they become obligated to sell the underlying stock at the strike price if the buyer of the call option decides to exercise their right to buy the stock. To put it simply, if a call buyer exercises his or her option contract, then your 100 shares will be called away. In other words, you will be forced to sell the shares at the strike price. Again, if you are confused, don't worry, we will run through an example later. In terms of maximum loss for the short call strategy, it occurs if the stock price rises to extremely high levels. Since there is no upper limit per se on how high a stock price can rise, the potential loss is theoretically unlimited if you do not have enough shares in your portfolio. That's when you need to buy the shares at the super high market price and then resell them at the strike price, which is much lower, resulting in substantial losses. For example, imagine the stock is trading at $45 now and the strike price that you have chosen is $50. After you sold the call option, the stock flew to the moon to say $1,000, $2,000 or even $10,000. Okay, I know I'm exaggerating, but let's say the stock price is $1,000 on the expiration date and you do not have 100 shares in your account. So what you have to do is that you will have to buy 100 shares at $1,000 per share from the open market and then resell it at $50 per share, which is your strike price. In this case, the loss is massive. You can do your own math. Again, just to emphasize, because there is almost no limit to how high a stock can go, your loss is technically unlimited. As for the maximum profit, it is limited to the premium received when selling the call option, which is similar to short put strategy. Let's say you receive $3 per share, aka $300 when you sold the call option. That's it. Your maximum profit is $300, nothing more than this. The investors achieve this maximum profit if the stock price remains below the strike price and the call option expires worthless. In other words, out of the money. Alright, let's go through an example. Suppose you are neutral to bearish on the stock of company XYZ, which is currently trading at $50 per share. You believe that the stock price will either stay the same or decrease over the next month due to some negative news in the industry or for whichever reasons. You then proceed to sell or write a call option contract with a strike price of $55 expiring in 1 month. The premium received for selling the call option is $3 per share. Multiply it by 100 shares, this means the premium we receive is $300, excluding any transaction fees. So now let's explore the different outcomes at expiration based on the various stock price scenarios. Scenario 1. The stock price of company XYZ remains below the strike price of $55 at expiration, in other words, out of the money. When this happens, the call option you sold expires worthless. You then get to keep the premium that was received at the very start, which will be your full profit. In this case, the amount would be $300 less any transaction fees. The second scenario is when the stock price of company XYZ rises above the strike price of $55 at expiration. The call option that you sold has intrinsic value now, on top of any extrinsic, in other words, time value. The intrinsic value is equal to the difference between the stock price and the strike price. So let's say the stock price is $60 now and your strike price is $55, then the call option has an intrinsic value of $5 per share. And let's say you did not manage to close the position at the expiration date, and if you do not have 100 shares in your portfolio, then you will have to buy 100 shares at the market price of $60 per share to fulfill your obligations by selling these 100 shares at $55 strike price. In this case, your loss will be $5 per share, which is a total of $500. But wait, remember you received $300 at the very start? That means your loss will be $200. Doesn't sound too scary, right? Well, as mentioned earlier, a stock can rise indefinitely. Right now, the example that I use is that the stock only rose to $60. Just imagine it goes up to $80, $100 or $500. Your loss will multiply. But of course, just like what I have shared for short put strategy earlier, you can also choose to close your short call position. Then you don't need to deal with the buying and selling of 100 shares per contract. Since you sold a call contract at the start, which means you have to buy back the call option to close the position. By doing so, you eliminate your obligation to sell the underlying stock at the strike price. The loss upon closing this short call position will depend on the difference between the premium initially received and the premium paid to buy back the call option. Are you confused? Don't worry. Here's an example. Remember you sold this call option and received $3 premium per share? Right now, because the stock keeps rising, this contract will become more expensive and is worth like $9 per share now. This means you will need to buy back the contract at $9 per share to close the position. So the calculation would be $300 premium received minus $900 premium paid, and your loss would be $600. Better than a potential unlimited loss, right? So yep, once again, the gist of closing the position is that your potential loss is limited. Okay, actually there are some nuances to short put and short call, such as naked call versus covered call and naked put versus cash secured put. And there is also a way to salvage option that is losing money by rolling it, but that's too much for this video, so I think I will save it for another video. And also I will skip the break-even scenario so as to not waste everyone's time. But before we move on to the last segment, if you have found this video useful in helping you to understand the 4 basic option strategies, please help to like, comment and subscribe, okay? Took me quite a fair bit of effort to do this up. Any form of support will be deeply appreciated. Alright, in summary, we have covered 4 most basic option strategies in this video: short put, short call, long put and long call. Each strategy offers its own unique opportunities and risks, and I hope this table will be useful for you. Feel free to screenshot if you have to for ease of reference. And before we go, here are some questions to test your knowledge. Feel free to pause the video to answer them. Anyway, some quick end thoughts from me. After going through the 4 basic option strategies, it seems like long put and long call strategies offer limited risks and potentially unlimited rewards, while short put and short call strategies carry higher risks and limited rewards. Generally, when the market moves unfavorably towards you, short positions can expose investors to huge and significant losses, thus making them riskier than long positions. Well, these pointers are not wrong, but does it mean we should all go with long positions? Interestingly, there are research that shows that the odds favoring a winning trade when selling options is higher than buying options, and that selling options generally outperforms buying options. I am not sure how accurate these studies are. The point here is, there are some nuances behind all these option strategies and things don't look as they are on the surface. If I have time, I will cover why I personally prefer selling options than buying them, as well as the so-called nuances behind. With that, I have come to the end of this long video. Do check out the first part if you haven't, and I hope it's useful. If you wish to see more videos on options trading, please comment down below so at least I know there are people who are watching and are interested. Okay, remember to help me with the YouTube algorithm by tapping the like and subscribe buttons. Thank you.